The ships were loaded, the deals were signed, the pork was already on the water. Then suddenly, bam, 12,000 metric tons canceled overnight. No heads up, no reasons given. Just a quiet line buried between the usual market updates. China cancels U.S. pork shipment. The timing? Perfect. The potential impact? Massive. But why now? Why the shipment? And why the complete silence? At 2:42 a.m. Beijing time on April 18th, a directive went out to Chinese importers. Cancel 12,000 metric tons of U.S. pork, already on its way. Not redirect, not delay, cancel completely. Both Bloomberg and Reuters confirmed the order. Ports in Ningbo and Dalian were told to stop clearance operations where the shipments were scheduled to arrive. The consequences weren't just symbolic, they were real, and they hit hard. According to the National Pork Producers Council, the move caused an immediate overflow of 26 million pounds of pork, about 110,000 slaughter-ready hogs, into the U.S. market, which was already swamped due to seasonal surplus. The worst hit? Iowa, North Carolina, and Minnesota, states that collectively account for nearly 60% of all U.S. pork exports to China. The Iowa Farm Bureau pegged the direct financial loss at $9.7 million, but said total fallout, like falling auction prices, overcapacity at plants, and job losses could push that number to 3 times higher. In Worth County alone, a pork processor cut 117 jobs within 48 hours. This isn't a disruption, it's a vacuum, said NPPC CEO Chris Novak. And guess who's filling that vacuum? On April 19th, the day after the cancellation, Tyson Foods stock dropped 4.3%, while Hormel Foods saw a 3.1% dip. Meanwhile, analysts were split. A Citigroup report downplayed the news, calling it a one-off retaliation. But Morgan Stanley disagreed, warning this might signal a major shift in how China sources its meat. The takeaway? Markets still treat agri-exports like short-term issues, not geopolitical flashpoints. That's a mistake. The CME Lean Hog Index dropped 6.5% in just 3 days, the sharpest fall since the 2020 pandemic disruptions. So, where is China heading? While U.S. pork sat idle in chilled containers, Brazil and Spain seized the opportunity. Brazil's Ministry of Agriculture reported a 28% jump in pork exports to China in April. Sao Paulo-based BRFSA filled emergency contracts that used to go to U.S. suppliers. Spain also moved fast. The country's pork export agency said Chinese orders surged 23% year over year, with fast-track clearance deals signed in Shanghai just days after the U.S. shipments were cut. Together, Brazil and Spain now supply 48% of China's imported pork. The U.S., just 19%, down from 33% in 2023. This isn't diversification, said Alicia Garcia Herrero, chief Asia-Pacific economist at Natixis. This is replacement, strategic replacement. The U.S. isn't being outcompeted, it's being outmaneuvered. So here's the question. If China keeps canceling, what do we do? Adapt or collapse? No official ban has been announced. Yet since mid-March, multiple U.S. pork producers report sudden and unexplained customs delays in Chinese ports. According to internal USDA reports obtained by Bloomberg, Smithfield Foods had 2 shipments held for extra inspections. JBS USA said China simply stopped responding to contract discussions. Behind the scenes, China quietly updated its import protocols. These new rules demand full origin transparency and strict biosafety standards, ones some U.S. plants don't meet yet. The result? A quiet filter. One that screens out American exports without violating WTO rules. Trade attorney Daniel Portman, who has advised on U.S. China trade conflicts since the 2018 tariff standoff, describes it as a blacklist in practice, disguised as technical regulation. If this move continues to spread, it could signal more than a diplomatic jab. It may mark the early stages of a sector-by-sector economic decoupling. And if pork is just the start, what's next? The economic impact isn't limited to lost exports. As of April 22nd, USDA cold storage data shows U.S. pork inventory reached 634 million pounds, a 14% increase from the previous year. Wholesale pork belly and loin prices plunged 17% in just 8 trading days, prompting major retailers like Kroger and Costco to offer unusual out-of-season discounts to reduce oversupply. But domestic consumption isn't catching up fast enough. A recent Wells Fargo agricultural analysis warns that if exports continue to shrink, farmgate profit margins could fall by more than 22% in just one quarter. Smaller farmers, already squeezed by higher feed and energy prices, may not withstand this downturn. In Missouri, 6 independent hog farms filed for Chapter 12 bankruptcy in April alone, citing overstock and falling prices. If this cancellation becomes the norm, the break in the U.S. food supply chain might not be felt at the grocery store, but at the farm itself. And pork may just be the preview, not the main act. China's newest 5-year food security plan, quietly passed in January, aims to cut reliance on imported food from politically unstable partners by 40% by 2028. While the U.S. isn't named directly, analysts at ING and Rabobank say the meaning is clear. Since 2023, China has poured investment into domestic agri-tech, built over 80 million cubic meters of grain storage, and locked in long-term pork and beef deals with Brazil, Spain, and Argentina. Meanwhile, U.S. soybean exports to China fell 25% in the first quarter of 2025, replaced by shipments from Brazil and Paraguay, according to Reuters verified customs data. This isn't a knee-jerk reaction, it's a calculated plan. China is treating food security like the U.S. treats semiconductors, says Darren Friedrichs, founder of Setonia Consulting. That means reducing the risk of any U.S. export disruption, accidental or otherwise. And if pork is considered a strategic item, the next moves could be even more severe. In 2024, China bought $15.6 billion in soybeans, $5.1 billion in corn, and $2.2 billion in beef from the U.S., making agriculture the second largest export sector to China, just behind semiconductors. But the first quarter of 2025 tells a different story. U.S. soybean exports are down 26%, corn down 33%, and beef cut in half. Meanwhile, agricultural imports from Brazil and Argentina have surged. Bloomberg reports that COFCO, China's largest state-owned food importer, is quietly pulling back from U.S. grain deals, choosing not to renew contracts and shifting bulk orders to Mercosur partners. Simultaneously, China finalized a major food security agreement with Russia in April, including 20-year preferential terms for importing barley, wheat, and beef, effectively securing replacements for U.S. suppliers. These aren't random trade choices. They're part of a bigger strategy, a methodical decoupling, unfolding one agricultural product at a time. So, if pork, soybeans, corn, and beef are quietly being removed from China's import lists, what does that mean for the future? This wasn't just a canceled shipment. It was a clear message, not only to American farmers, but to every industry linked to China's demand, because when 12,000 metric tons of pork are turned back mid-shipment, that's not a supply issue, it's leverage. So now the bigger question is, if China can surgically eliminate U.S. pork, what happens when they shift their focus to semiconductors, pharmaceuticals, or even U.S. Treasury bonds? The next cancellation may not appear on a shipping manifest. It might show up in bond markets, stock sell-offs, or broken supply chains. So before you scroll away, consider this. What if the real decoupling isn't dramatic or sudden, but slow, quiet, and deliberate, one cancellation at a time? And if that's the case, then the biggest move China is planning still hasn't happened yet. Stay tuned for more hot news from 3 Daily News. Catch you in the next one.